My name is Andrew Stotts, the Valuation Masterclass Bootcamp, and tonight we're going to see another final presentation. 150 hours in 6 weeks, super intense studying, and students are presenting today. So, are you ready to present today?
Yeah, sure.
I'm looking forward to it. I know we were just talking about how you've been working so hard,
Yeah.
but it's almost over. So, let me pull up your presentation. One second. All right. So we see your presentation, and I'm going to exit in just a second. And when I do, you just start. Okay.
Okay, thank you.
So I'm going to exit now. You can start now.
Okay. Hello, everyone. Welcome to our final presentation of the bootcamp. So I initiated the coverage on Daimler Truck Holding AG with a buy recommendation. This is based on the target price of 43 euro, implying an upside of 19%. I derived the target price from DCF-based valuation using weighted average cost of capital of 6.3% and terminal growth rate of 1%. Now, my three main story is that the US still have offset the EU decline as tax incentive drive the demand. Second is the margin persists as vocational truck have reshaped the cost structure. And lastly is the electric, hydrogen, and autonomous truck have paved the way forward for the company. So the key risk is that it's a cycle market demand, supply chain, and workforce disruption, and also the delay in zero emission vehicle adoption. So a little bit about company background. Daimler Truck Holding is a German global leader in commercial vehicle industry. The company core revenue stream come from sales of trucks. So the Daimler is a market leader that dominates the North American market with 40% of total area market share. And the company also have a strong presence in Europe, holding 20% of the total market share. And right now it's on the track to develop the dual strategy of battery electric and hydrogen-based drive and also advancing in technology of automotive driving technology. Now, my first story is that the US still have offset the EU decline as the lobbyist of US still have capitalized on Section 179 tax incentive, which allow business to fully deduct the vehicle cost before this year end, and next year is going to be reduced to only 50%. So this held Daimler stay on track to meet the annual target of around 500,000 unit sales. And those seasonality purchasing trend is continue as the Q4 always be their strongest strongest sales quarter, and particularly in the North American, further boost the year-end demand and solidify Daimler position in the key market. And that's the reason I forecast the revenue conservatively to only allow 3% growth for the next 4 years because the fluctuation demand in the EU. Now, the Daimler net profit margin have dipped 4.6% in Q3 of 2024. This is due to impact of rising input costs and sales mix shift toward the vocational truck. Despite those challenges, management commit to improve production efficiency and leveraging economy of scale. Those efforts compounding with the potential tax saving on depreciation, providing pathway for margin to stabilize and long-term profitability. So it's expected to improve EBIT margin for every year, and it's gonna get better in the following year. Lastly is the advancement in electrification and hydrogen power and autonomous solution. Daimler have aimed to introduce autonomous truck by 2027 and aim to achieve over 3 billion in revenue by 2030. And this is to tackle the problem of driver shortage and also expanding manufacturer capacity for zero emission vehicle have further solidified Daimler commitment to future-ready technology. Now let's look at the truck industry overview. So the the industry is valued at $2.6 trillion in 2023 and is projected to reach 3.7 trillion by 2032. That is for 4% compound annual growth rate according to Fortune Business Insight. The growth is fueled by rising e-commerce and infrastructure investment, increasing in demand for efficiency local truck, especially on the last mile delivery. And this trend is indicate a future where sustainability is integral to industrial growth. Now, the International Energy Agency or IEA have predicted the electric truck may account to approximately 10% of the heavy-duty truck sales by 2030. And despite the advancement in eco-friendly technology, it's still facing a significant hurdle as the price. The electric truck is 2.5 to 3 times more expensive than the diesel alternative. For example, the diesel Class A truck costs around 180,000, while the electric model is exceeding 400,000. And right now, Europe have only 10,000 charging point for medium and heavy duty truck, but it needs 300,000 by 2030. Overcoming those barriers will require substantial investment in charging network and consistent policy support from the government. Now we're moving on to the quarterly results. So we can see that the total revenue have decreased 5% year on year, and the company saw 1.1 year-on-year decrease on gross margin and 2% on net margin. So this drop is significantly influenced by the decline of unit sale in key regions like EU30, where the truck market were down by 21%. Now the latest news on the market is that Daimler has fast-tracked the development of the dual strategy of electric and hydrogen truck that plan to introduce the model by 2025, and the Daimler stock have saw 16% on October. This is advantage to take on the momentum trader for strong Q4 performance as I expected. And they already completing their first tranche of share buyback, and the second tranche is already commenced on 17 September, and it's going to continue to repurchase until completion of the 1st August 2025. So this gave the shareholder to capitalize on the stock price. Now, the consensus estimate is slightly downward to 2.1, and the mean target price suggested potential 27 upside compared to the current price. And the forecast consensus of stable revenue growth with a recovery to 9.1% in 2026 after drop in 2024, and the net margin expected to reach 7.1 in the same year. Now let's look at the revenue insight and geographic breakdown. So in 2023, Daimler earned revenue of 55.8 billion, making 10% increase from the previous year. The Daimler Truck North America segment is 39%, and the largest contribution of the Daimler revenue. It also shows 7% compound annual growth rate. And for geographically, it's North American for sure, for account for 47, Europe for 31, Asia for 13, and the rest of the world for the last 9%. Now we're moving to Professor Andrew Stott for Element, which is FVMR framework. So overall, Daimler is moderately attractive relative compared to another 240 non-financial company in Germany. The fundamental is mixed. The valuation is ranked the worst as it trades on high multiple. The momentum is excellent on the top 10% with still highest momentum and high recurring earning per share growth. But a little bit concern is on the high risk because they have high net debt to equity and bad interest coverage. The second one is world-class benchmark. So right now we're gonna move to benchmark it against 137 large industrial companies worldwide. So Daimler have ranked in the fifth bracket here. The profitability remains strong, consists as the bracket number 5, and the growth on the 12 months slipping from the bracket number 1 in 2021 to bracket number 4 after performing on the top tier for the last 3 years, while the expense direction to volatility have stabilized at the bracket number 3, showcase the Daimler ability to manage its costs. Okay, now we're moving on to my forecast on the P&L. So you can see that 2024, due to the decrease in EU sale, I forecast, and the last 3 quarters, we can see I forecast the drop of 4.5%, and later on, it's gonna continue to have the growth of 3% for 4 years later. And you can see the net profit gonna start to climb up, but it's gonna continue to, but it's not gonna reach the peak on 2023. And the net fixed assets continue to grow, and they have to invest it on dual track strategy of the EV and hydrogen-based drive vehicle, as well as long-term debt to fund those fixed assets. Uh, right now, you can see that why I highlighted dividend payout. Dividend pay is because they recently changed dividend payout ratio. On 2023, their policy is 40%, but right now they increased to 40 to 60. So they can see that the company start to mature. And lastly is the EBIT margin. It's going to continue to be a little bit lower until they can gain the market of zero emission vehicle and the market in the EU back to the level before. And the cap A is that they have to invest in those ZEV vehicle as well. Okay, now we're moving on to relative valuation. So you can see that Daimler looks cheap in price per book, and this result in Daimler significantly discount based on 2025 price per book to return on equity multiple. That show is very undervalued. But on the other side, it is very premium based on uh, PE to earning per share multiple compared to Germany and the world, because I predict the low growth in the future. Lastly is on valuation and target price. So I assuming a risk-free rate of 2.5%. Given the current interest rate fall and the market equity risk premium of the Germany market of 6%, Daimler has been high beta stock, so I assume beta of 1.2%. That's the same as previous average. And this will result in cost of equity of 10%. And I forecast a capital structure around 45 debt to total equity. This result in weighted average cost of capital and discount rate of 6.3%. And I use terminal growth rate of 1%. In my best case scenario, I anticipate a gross margin of around 21% that lead to value of 43 euro per share based on free cash flow to firm methodology. In my sensitivity analysis on the following case, the optimistic case, assume gross margin of 23%, resulting in target price of 48 euro. Conversely, on the pessimistic case of only gross margin of 19%, it will result in 38.9 share price. Last is the bottleneck of the supply chain. The risk is that the supply chain disruption, there's a risk for internal bottleneck due to low equipment availability and failure of production plant or factory. That would result in cost being occurred. And secondly is the economic slowdown. As you can see that commercial vehicle industry is highly cyclical and skeptical in the global economic downturn. The slowdown of economic growth can lead to reduce in demand for commercial vehicle. And potential. Lastly is the challenge in EV adoption. The zero emission have been a significant hurdle, including the slow rollout of the charging infrastructure and also high battery cost. And lastly is the limit available of raw material like lithium. And that's the end of my presentation. If you have any question, please feel free to ask.
All right, we do have some questions. Let's just go through some of them. Momen asked the question, I see that the stock price started to go up again recently. What would be the main thing that would push it up even further?
So the first catalyst that I would say there is the Q4 performance that is expected to be seasonality. It's always show that Q4 will have a strong unit sale. So if it can beat the estimate, it surely can, the stock price can be up by 15-20% easily.
Okay.
And second catalyst is that the share buyback that gonna continue to buy of $968 million, and that's gonna give shareholder to capitalize on the on the stock price. Sorry.
Okay. And Momen asked, when it comes to EV electric trucks, who would be the leader? Who do you think? Daimler, Volvo, a Chinese company? And I guess he's talking about 3 to 5 years out.
Yeah, pretty understand that. So firstly, I would say that the company have a little bit of success. So right now the EV, the longest drive that they test is 1,027 kilometer. But that still doesn't enough. So the company move forward from only rely on the EV, on the electric vehicle only. They develop the dual track that use the hydrogen base and EV base that gonna drive the range a little higher. And for the Volvo, they already developed the hydrogen, and I think they share the partnership with them. So I think they can beat China company because the technology advancement that they have, and the partnership between those companies of the Volvo and Daimler.
Mm. Let me see. Another one. So Olatunji says, what is the company's plan to increase electric truck sale back in EU30? And what is your take on it?
Oh, that definitely kind of hard. If you look at their total portfolio right now, the EV vehicle is only account for 0.65%, and that already increased 200% from the 2022, which is only 400 something. So it's gonna be hard. It's gonna be tough. But with the EU regulation as well, they need to develop it this way in order to gain back the market share and get more sales out in it. But if they can do it, they're gonna if they are the first mover, I think they're gonna have impact significantly on their market share, up from 20% to maybe 30 or 40%. It's depends. Yeah.
Sometimes you hear all the time the companies say, yay, EV and all of that. But then when you look at what they actually do, I think they're playing a game hoping that the EU sees its unreasonableness and pulls back. So it'll be interesting.
Yeah, for sure. Because if you see the number is like 0.65%, it definitely not impact the company revenue at all. Yeah.
Another question from Momin. The company's trading at a low price to book, low PE. So why do you think the market is undervaluing it?
So as I say that it already missed the last three estimate earnings per share. So when a lot of investors see this, like they start to lose their confidence in the company management. And also because even though the US have the strong sale, but the strong sale have come from vocational truck, which is a new model that is still have a bottleneck, and the management try to like improve efficiency, and that is a cost as well. So that's caused that EBIT to turn down, and that caused the stock price to soar as well.
I don't even know what vocational truck means.
So it's hard to explain. It's like it's just that I would say it's like the on the back part is different from the original that they already built. So this will cause that to invest in the more infrastructure, than the first.
Ukrit says, what's your thoughts on the European and Chinese market for Daimler? How are they going to do there?
So for the European, they have 20% of the total market share. And as the company is based on Germany, I think they would like to continue to improve. But the competition over there is hard, and also the regulation is more strongly than US. So we'll see that how the EV going and how company can improve. But for the Chinese market, the issue is not their main part, and there's not their main. It may be attractive, but I don't think the company moving forward to that direction at the moment.
And Prow asked the question, why do you expect 45% debt to total capital? Would it be risky for the company?
No, if you I want to say no, but that would be impossible. But to be fair, it's no, because if you understand the European economic, the company mostly based on debt from bank, and bond is very less market compared to the US, the section. So, and right now the cost of debt is only 0.7, which is very cheap because it have loan with collateral and it's strong present in Europe. So that is very cheap. And the debt to 45% is already dropped. Right now it's right now it's around 60% that I drop it in my forecast because I don't think they're gonna invest it a lot in the future. Yeah.
Yeah, and a little technical lesson on that in the model. Remember that that's market value of equity. So when we say 45% and debt as a percent of total capital,
Mm-hmm.
that's looking at market value. And because the price to book is down close to one, it's, you know, the equity is very low, and it's more like the net debt to equity, you know. And then if the company's price to book went up to 1.5, as an example, all of a sudden the
So
that
the debt
percent of
levels will drop.
yeah. So that's a little technicality in the model. So how does it feel to graduate from the Valuation Masterclass Bootcamp?
Always feel very great, very rewarding to all the effort that I give into this class. It's very fun. It is a long and tough journey, 6 weeks, investing a lot of hours per day and per week. But overall, I think I have built like more strong foundation to tackle the real world financial challenge with more confidence. Mm-hmm.
Yeah, let's talk about that transformation. I mean, when you came into the Valuation Masterclass Bootcamp, you're already fourth year student, top university, studying
And
finance. You know a lot about finance. You've been involved in competitions and all that. What's the transformation that you made in the bootcamp?
so it's pretty different. I have do some financial model before, but to do the forecast is connecting dot to dot. So you need to, so maybe in university you just giving the rate of, okay, we're gonna forecast 4.5, and that is based on professor. But in the real world it's very different. You need to come up with the assumption. You see the past performance, you see the quarterly result, you look at the overall on the from the top down perspective of the global economic, from the industrial economic, and come up with the percentage that you confident that you can defend your argument with anyone.
Mm.
And that very, I mean, that is like in the real world, and that is very different in the classroom. Yeah, and that is very good information from this class.
And what was it that what was your reason for joining?
Oh, it's you. I met you in the class of ethics. It's a really fun and informative class on ethic for CFA. But I think I learned a lot from you about the story you tell. Maybe I didn't get it 100%, but getting to learn from someone that experienced a lot in the industry is very very good, and it's shortened my time that I don't have to experience those mistake or those situations before, but you just tell me, so it's just like shortcutting for me, and it's very good, and just want to thank you.
Yeah, yeah, my
Yeah.
pleasure. Well, you've done a great job, and that was a great presentation. So now it's time to relax. Well, you probably don't have time to relax because you got to work on exams and everything else, but at least you can relax from this. Well done. I'm going to take you out now, and we'll talk on Slack, and I'll see you on Friday.
Okay, thank you.
Yep. Well, that was a great presentation on Daimler and thinking about what's the positioning of that company. The price to book is, pretty close to book value, meaning you're getting almost all of the future cash, the future returns basically for free. So at book value, it looks like it could be attractive. What's going to depend is what happens with the regulations in EU. And if they just get tougher and tougher, it could be a squeeze for them. But maybe that's in the price. I don't know. Anyways, if you want to build a competitive advantage in company valuation, join us at Valuation Masterclass